The first shell corporation opened its doors in Atlanta on a Tuesday morning in late 1999. No ribbon cutting, no press release. Just a federal EIN application filed through a registered agent in Delaware and a lease agreement signed in cash for a 3-room suite above a barbershop on Old National Highway. The business listed itself as an entertainment promotion company. The owners were listed as private investors. The bank account showed an opening deposit of $73,000 in sequentially numbered hundreds. No one asked where the money came from. That was the idea. Black Mafia Family Entertainment did not begin as a record label. It began as a question someone in the Drug Enforcement Administration asked in the spring of 2000. The question was simple. How does a man with no declared income lease 5 vehicles in a single month? The answer came slowly, first through subpoenas, then through wiretaps, then through a 27-month surveillance operation that would eventually span 8 states and involve over 200 federal agents. What they found was not a music company that moved drugs. It was a drug enterprise that purchased the appearance of legitimacy, one platinum plaque at a time. Demetrius Flenory did not invent the method. He perfected it. Born in Detroit in 1968, he understood early that the streets respected volume, but the system respected paperwork. By 2001, his organization was moving an estimated 200 kilograms of cocaine per month from suppliers in Texas and California into distribution hubs in Atlanta, St. Louis, Los Angeles, and Miami. The infrastructure was military in its precision, compartmentalized cells, rotating vehicles, encrypted phones replaced weekly, a logistics network that treated cocaine like cold-chain pharmaceuticals. But the money was the problem. Cash in that quantity is a biological organism. It grows, it smells, it demands feeding. At its height, the organization was generating an estimated $270 million annually. Most of it arrived in denominations so small they had to be counted by weight. $1 million in 20s weighs 50 kilograms. Multiply that by 12 months. Now hide it. The usual routes were saturated. Car washes, barber shops, check cashing stores. These worked for 5 figures, not 8. What Flenory needed was a vessel large enough to hold the flood and glamorous enough to explain it. He needed an industry where excess was expected, where young black men could arrive with duffel bags full of cash and leave with tax deductions. He needed hip-hop. The blueprint was drafted over a series of meetings in the spring of 2000 between Flenory, his younger brother Terry, and a Detroit promoter named Jacob Araboff, who was already known for moving jewelry to entertainers. The concept was elegant. Rather than create a fake business, they would fund a real one. They would sign actual artists, book actual shows, distribute actual merchandise. The music would not be a front, it would be the front door. Behind it, street proceeds would flow upward through promotional budgets, artist advances, and appearance fees. The venues would be nightclubs they controlled. The headliners would be paid through corporate accounts funded by narcotics income. The invoices would list marketing services. The accountants would see revenue. The ledger would balance. They called it a mixtape strategy, a term borrowed from the artists themselves. In hip-hop, a mixtape is not an album. It is a calling card, a proof of concept, low budget, high impact. It bypasses the traditional label machinery and goes directly to the streets. Flenory applied the same logic to his financial model. He would not wait for banking approvals or investor meetings. He would fund the operation himself in cash through a network of street-level promoters who already worked for him. Each promoter would be given an entertainment budget. That budget would be used to book shows in clubs the organization either owned or controlled. The door receipts would be deposited into BMF entertainment accounts. The expenses would be paid out to artists, DJs, and security. All of it documented, all of it taxable, all of it clean. The first test case was a party in Atlanta on October 7, 2000. The venue was Club Chaos, a mid-sized night spot on Peachtree Street. The headliner was a rising Detroit rapper named Blade Icewood. The promotional budget was $12,000. Flyers were printed, radio spots were purchased, security was contracted. The door charge was $20. Over 600 people attended. Gross receipts totaled $14,200. After expenses, the event showed a profit of $800. The books balanced, the club was happy, the artist was paid, and $12,000 in narcotics proceeds had just been transformed into legitimate business revenue. The cycle had closed. Within 6 months, BMF Entertainment was hosting events in 4 cities. The model scaled. Each event required upfront cash. That cash came from street operations. The door receipts came back as bank deposits. The delta between cost and revenue was insignificant. What mattered was the movement. Money entered dirty and exited stamped. Every flyer, every invoice, every payment to a DJ or security guard became a transaction that could be traced, taxed, and explained. The IRS does not audit nightclub promoters. They audit people who live in mansions and drive Maybachs without a job. Flannery now had a job. The organization formalized its structure in 2001. BMF Entertainment, incorporated as a Georgia limited liability company with Demetrius Flannery listed as managing member. The corporate address was a rented office in Buckhead. The business activity was described as artist management and event promotion. The operating agreement was filed with the Secretary of State. The entity obtained an EIN. It opened business checking accounts at Wachovia and SunTrust. It applied for and received a line of credit for $30,000. It purchased liability insurance. It hired an accountant. On paper, the company was indistinguishable from 1,000 other boutique entertainment firms operating across the South. But the back end was different. The funding source was a web of courier routes that moved cash from street dealers to stash houses to counting rooms to promotional budgets. The couriers were organization members whose sole job was logistics. A typical route began in Los Angeles, where cocaine was purchased wholesale from Mexican suppliers affiliated with the Sinaloa Federation. The product was driven to Atlanta in rental trucks equipped with hidden compartments welded into the frame. The compartments were sophisticated: pneumatic lifts, false floors, dimensions calculated to avoid detection by drug dogs trained on scent cones. The trucks were driven by couriers with clean records. They obeyed traffic laws. They did not speed. They did not smoke. They looked like furniture movers, which is what the manifest said they were. Upon arrival in Atlanta, the cocaine was transferred to distribution cells operating under independent managers known as shot callers. Each cell was allocated a specific territory. Each shot caller was responsible for converting product into cash. No credit, no consignment. The rule was absolute: payment up front or no delivery. The discipline kept the operation insulated. If a cell was compromised, it could not bring down the network. All it could offer was a name, and names in the organization were disposable. The cash collected by shot callers was returned weekly to collection managers. The collection managers operated out of short-term rental properties that changed every 30 days. The cash was sorted, counted, and banded. Each band represented $10,000. The bands were placed in vacuum-sealed bags. The bags were loaded into suitcases. The suitcases were transported by couriers to secondary locations, where they were logged into ledgers maintained by the organization's de facto CFO, a former automotive finance manager named Fleming Daniels. Daniels did not touch drugs. He did not manage distribution. His sole function was money. Specifically, the movement of currency from the underground economy into the legal one. The method he refined became known internally as layering. It worked like this. Street cash entered the system as promotional budgets distributed to event coordinators who were instructed to book talent for nightclub appearances. The coordinators were given explicit instructions: pay the artist in cash, collect a signed receipt, deposit the door revenue into the BMF Entertainment account, report the expense as an artist appearance fee. The artist received anywhere from $5,000 to $20,000 per event, depending on their profile. The organization received a clean deduction and a corresponding revenue line that justified the expense. The IRS saw a business operating at low margin. The reality was that the margin did not matter. The goal was not profit, it was conversion. Between 2001 and 2004, BMF Entertainment hosted an estimated 370 events. The cumulative promotional spend exceeded $18 million. The average event laundered between $10,000 and $30,000. Some weekends saw 4 events running concurrently in 4 different cities: a party in Atlanta on Friday, a show in St. Louis on Saturday, a club appearance in Miami on Sunday, a showcase in Los Angeles on Monday. Each event generated paperwork, contracts, invoices, payroll reports, bank deposits, tax filings. Every document became a thread in a fabric of legitimacy. The operation expanded into artist development in 2003. Rather than simply book outside talent, BMF Entertainment began signing its own acts. The first was a Detroit rapper named Barima McKnight, who recorded under the name Bleu Da Vinci. He was offered a 3-album deal with a $50,000 advance per album. The advance was paid in cash. The contract was filed with the American Society of Composers, Authors, and Publishers. The artist began recording at Patchwork Studios in Atlanta. Session costs were billed to BMF Entertainment. Producers were paid through the corporate account. Engineers, mixing, mastering, marketing, distribution. Every line item was an expense that justified prior income. Bleu Da Vinci's debut single was released in 2004. It received regional airplay. The music video was shot on location in Atlanta with a budget of $35,000. The video featured luxury cars, jewelry, and nightclub scenes. It was posted on music video platforms. It was promoted through paid advertising on urban radio stations in 12 markets. It did not chart nationally. That was irrelevant. What mattered was the documentation. The single had an ISRC code. The video had a production contract. The promotional spend had receipts. The operation was no longer theoretical. It had a product. What the organization also had, by mid-2003, was the attention of federal law enforcement. The first intercept came not from a wiretap, but from a confidential informant inside a rival drug organization in St. Louis. The informant, a street-level dealer facing a 20-year mandatory minimum on a firearms charge, provided DEA agents with a detailed account of BMF's supply chain. He described bulk shipments arriving weekly from Atlanta. He described distribution protocols. He described enforcers. And he described the use of a record label as a cover. The information was passed to the DEA Atlanta field office, where it landed on the desk of a supervisory agent named Jack Harvey. Harvey requested a preliminary financial workup. What came back was a profile that made no sense on paper, but perfect sense in practice. Demetrius Flenori had no declared income beyond BMF Entertainment distributions, yet his asset profile included 5 vehicles registered in his name, 3 residential properties, and documented cash expenditures exceeding $400,000 annually. His credit report showed no mortgages, no car loans, no lines of credit beyond the $30,000 business account. He paid for everything in cash, which meant the cash had to be coming from somewhere the IRS did not see. Harvey opened a preliminary investigation in June of 2003 under the DEA's Organized Crime and Drug Enforcement Task Force Authority. The case was titled Operation Motor City Mafia, a reference to the organization's Detroit roots. The initial objectives were standard: identify the supply chain, map the distribution network, establish probable cause for electronic surveillance. The team included agents from DEA, FBI, IRS Criminal Investigation, and the Atlanta Police Department's Narcotics Unit. The case agent was a 15-year DEA veteran named William Cotter. His specialty was financial architecture, not the drugs, the money. Cotter's methodology was patient. He did not raid stash houses. He did not flip street dealers, he followed the cash. His team began by obtaining subpoenas for BMF Entertainment's corporate bank records. What they found was a company with erratic revenue patterns and expenses that exceeded income in 17 of the previous 24 months. Yet the account never overdrew. Shortfalls were covered by cash deposits often made on the same day an expense cleared. The deposits ranged from $5,000 to $49,000, just under the currency transaction report threshold of $50,000 that would trigger automatic federal reporting. The pattern was textbook structuring, a federal crime under Title 31 United States Code, Section 5324. Armed with evidence of structuring, Cotter secured a Title III wiretap authorization on Demetrius Flannery's cell phone in September of 2003. The wiretap order allowed for 30 days of interception with the possibility of extension. The first intercepts were cautious, coded language, references to quantities as units, prices as donations, locations as relatives, standard street protocol. But the volume was staggering. Flannery received an average of 70 calls per day. Most were logistics, delivery times, payment confirmations, personnel disputes. By week 2, the team had intercepted conversations involving over 40 unique voices across 6 states. One conversation, recorded on September 19, 2003 at 11:42 a.m., stood out. Flannery was speaking to his brother Terry about an upcoming concert in Miami. The dialogue was mundane until the end. Terry asked whether the promotional budget had been delivered. Flannery replied that it was en route and would arrive before the weekend. Terry asked how much. Flannery responded 50. Terry said good. Flannery added that the artist fee was 15 and the balance would cover expenses. Terry confirmed. The call ended. The team replayed the recording a dozen times. 50 meant $50,000. 15 meant the artist appearance fee. The balance, $35,000, was the laundering margin, a single event, $35,000 converted. The math was simple. Multiply that by 4 events per weekend. Multiply that by 50 weekends per year. The result was $7 million laundered annually through nightclub promotion alone. And that was conservative. The actual figure, Cotter estimated, was closer to $12 million when factoring in artist advances, merchandise sales, and ancillary income streams. The wiretap was extended, then extended again. By December of 2003, the team had recorded over 9,000 intercepted communications. The targets expanded from Demetrius and Terry Flannery to include 37 co-conspirators operating in 8 states. The network was larger than anyone had anticipated. It was not a gang. It was a corporation, with regional managers, compliance protocols, conflict resolution procedures, human resources. There were retirement plans for members who wanted out, severance packages, death benefits for families of members killed in the line of duty. The organization paid legal fees for members under indictment. It provided bail money. It subsidized appeals. And it had a brand. The name Black Mafia family was not whispered. It was advertised, logo apparel, promotional materials. Music videos featured BMF imagery. Artists signed to the label wore BMF chains. The organization's annual White Party in Atlanta drew over 2,000 attendees, including athletes, actors, and recording artists with major label deals. The event was covered by hip-hop magazines. Photographs appeared in glossy spreads. Flannery was referred to in print as Big Meech. His brother as Southwest T. They were not hiding, they were marketing. Which was, in hindsight, the operational flaw. Visibility is leverage until it becomes liability. By 2004, BMF Entertainment was too visible. The White Party was too extravagant. The artist roster was too ambitious. The lifestyle was too loud. Federal agents were not just monitoring phone calls, they were attending the parties. They were photographing the guest lists. They were cataloging the vehicles in the parking lot. They were running the license plates. They were cross-referencing attendees with known narcotics distributors. The web was tightening. In March of 2004, the investigation gained its most critical asset, a cooperating witness. His name was Omari McCree, a mid-level courier who had been arrested in Los Angeles with 11 kilograms of cocaine in the wheel well of a rented Chevrolet Suburban. Facing a mandatory minimum of 10 years, McCree made a calculation. He contacted the Assistant United States Attorney handling his case and offered to provide testimony in exchange for a cooperation agreement. What he offered was not hearsay. It was first-hand knowledge. He had delivered cash. He had picked up drugs. He had attended organizational meetings. He knew the structure. He knew the players. And he knew about the record label. McCree described the laundering operation in granular detail. He explained how promotional budgets were dispersed. He identified Fleming Daniels as the financial architect. He described the counting houses. He provided addresses. He named couriers. He explained the layering process. He testified that the music business was not incidental. It was the mechanism. The whole operation depended on the ability to move money through entertainment expenses. Without it, the organization would have collapsed under the weight of its own cash. The record label was not a front. It was the foundation. Armed with McCree's testimony, Cotter's team escalated. On October 21, 2004, federal agents executed simultaneous search warrants on 31 locations across 6 states. The targets included stash houses, counting rooms, corporate offices, and residential properties owned by organization members. The haul was encyclopedic: cocaine, firearms, cash, financial records, ledgers, cell phones, computers, jewelry, vehicles. At BMF Entertainment's Buckhead office, agents seized 4 desktop computers, 17 boxes of documents, and a safe containing $83,000 in banded currency. The documents included contracts with over 50 artists, invoices for promotional services, and a handwritten ledger listing cash disbursements totaling $6.2 million over 18 months. The ledger was the kill shot. Each entry listed a date, a recipient, an amount, and a purpose. Some entries read promotional budget, others read artist advance, a few read simply payroll. The handwriting was identified through forensic analysis as belonging to Fleming Daniels. The amounts corresponded to cash deposits made into BMF Entertainment accounts within 48 hours of each entry. The pattern was unambiguous. Narcotics proceeds were being funneled into the entertainment company and dispersed as business expenses. The record label was not a legitimate enterprise that happened to be funded by drug money. It was a purpose-built financial instrument designed exclusively for laundering. Demetrius Flannery was arrested on October 30, 2005, at a residence in Las Vegas. He did not resist. He did not flee. When agents entered the property, he was seated in the living room watching television. He was read his rights. He was placed in handcuffs. He asked if he could make a phone call. He was told no. He was transported to the DEA Las Vegas field office, where he was processed and held pending extradition to Detroit. His brother Terry was arrested the same day in St. Louis. The coordinated takedown included the arrest of 34 co-conspirators. The indictment was 150 pages. It charged the defendants with conspiracy to distribute cocaine, money laundering, and operating a continuing criminal enterprise. The statutory maximum was life without parole. The trial began in United States District Court for the Eastern District of Michigan on September 11, 2007. The prosecution called 67 witnesses over 9 weeks. The evidence included wiretap recordings, financial records, cooperating witness testimony, and surveillance footage. The defense argued entrapment. They argued selective prosecution. They argued that BMF Entertainment was a legitimate business and that any criminal activity was conducted by rogue members without the knowledge or approval of the Flannery brothers. The jury deliberated for 6 days. On November 16, 2007, the jury returned a verdict: guilty on all counts. Demetrius Flannery was sentenced to 30 years in federal prison. His brother received the same. Fleming Daniels received 20. Over 40 co-conspirators accepted plea agreements with sentences ranging from 5 to 15 years. The organization was dismantled. The assets were forfeited. The nightclubs were sold. The record label was dissolved. The contracts were voided. The artists moved on. But the model persisted. In the years following the BMF prosecution, federal authorities identified at least 12 other drug trafficking organizations using entertainment promotion as a laundering vehicle. The tactic had been pressure tested. It worked. The music industry, with its culture of cash transactions, independent contractors, and appearance-based revenue, offered a near-perfect ecosystem for converting narcotics proceeds. The margins were irrelevant. The documentation was easy. The scrutiny was low, and the lifestyle was indistinguishable from legitimate success. A drug dealer in a Maybach is suspicious. A record executive in a Maybach is aspirational. The final irony is that BMF Entertainment, despite being a criminal enterprise, produced real music. Blue Da Vinci released 2 albums. They sold modestly. They were reviewed in hip-hop publications. They were streamed. They were added to playlists. The music was not great. But it was not fake. The artists were not actors. They were rappers trying to break through in an industry that chews up and spits out 1,000 hopefuls every year. They signed with BMF because they were offered money and opportunity. They did not know the source. Or maybe they did. The line between hustle and crime in hip-hop has always been thin. The genre was born from necessity. It celebrates survival. It valorizes the come-up. It does not ask questions about the seed capital. Flannery understood this. He understood that hip-hop was not just a genre. It was a language, a code, a value system. It rewarded authenticity. It punished pretense. If you claimed the streets, you had to prove it. If you claimed success, you had to show it. BMF Entertainment did both. It claimed the streets by funding artists who came from them. It claimed success by throwing parties that looked like coronations. The brand was not a lie. It was a translation. The drugs were the product. The music was the message. Today, Demetrius Flannery remains incarcerated at Federal Correctional Institution Sheridan in Oregon. His projected release date is 2031. His brother Terry was released to a halfway house in 2020 after his sentence was commuted for health reasons. He lives in Detroit. He does not give interviews. The case files remain sealed. The wiretap recordings are archived. The financial records are boxed and stored in a federal evidence warehouse in Michigan. The music, however, is still available. You can stream it, you can download it, you can add it to your playlist. The production quality is dated. The lyrics are competent. The hooks are serviceable. It sounds like every other independent rap album released in the early 2000s. Which is the point. It was never supposed to be great. It was supposed to be real. And it was. Real artists, real studios, real promotion, real revenue. The only thing that was fake was the story behind the money. But in hip-hop, the story is the product, and the product for a while sold. The record label that was not a record label taught federal prosecutors a lesson. Follow the music, not because the music is criminal, but because the music is expensive. Someone has to pay for the studio time. Someone has to pay for the music videos. Someone has to pay for the billboards and the radio spots and the club appearances. And if that someone has no job, no credit, and no declared income, then the money is coming from somewhere the government cannot see. Which means the music is not the crime, it is the receipt. BMF Entertainment was not the first organization to launder money through entertainment. It will not be the last, but it remains the most successful case study in how the drug trade learned to speak the language of capitalism. Incorporate, document, diversify, pay taxes, hire accountants, build a brand. The cocaine was the revenue stream, the record label was the business plan, and the business plan for a time worked, until the wiretaps caught up, until the ledgers were seized, until the jury returned its verdict, until the system, as it always does, won. The trial transcript runs to 11,000 pages. The evidence inventory lists 3,412 items. The financial analysis estimates total laundered proceeds at $270 million over 6 years. The human cost is harder to quantify. Lives destroyed, families separated, communities fractured. The music industry, for its part, moved on. The clubs reopened under new management. The artists found new labels. The promotional model was quietly retired. No one talks about it now. It is a cautionary tale told in law enforcement seminars, a case study in financial tradecraft, a footnote in the history of American crime. But the music is still there, on streaming platforms, in record bins, in the algorithm, waiting to be discovered, waiting to be played, waiting to remind anyone who listens that every song has a price, and someone, somewhere, always pays it.